G'day folks, welcome back to another update for the high grade copper and US crude oil. So we've hit the resistance with copper, and crude has hit off and bounced off a support level. We'll go into charts in a minute, and also we're going to include some back testing to show you the results of the stop loss approach and the average down approach. Depends on which one you choose. And before we go any further, make sure you hit that like and subscribe button to support the channel. Now, first off, looking at the fundamentals, we'll look at US crude. So OPEC plans to gradually unwind production cuts starting April 1, which may impact oil prices. US energy executives expressed concerns over trade policies and tariffs, which have increased drilling costs and heightened market uncertainty. Analysts forecast Brent crude oil prices averaging $75 a barrel in 2025, with potential declines to $68 per barrel in 2026 as inventories build. For high-grade copper, US copper prices have surged to record highs, driven by strong demand and anticipated import tariffs. The US relies heavily on imports for over 44% of its copper consumption, highlighting supply vulnerabilities. Analysts predict a long-term increase in global copper demand, potentially requiring significant annual production additions. So first we look at the long-term trends, just get an idea of which way the overall trend is moving. On the monthly here, we've got the CCI and the price well above the moving averages, so that's a bullish trend. There's no divergence showing up there at the moment. On the weekly, that's also bullish, with the CCI breaking above and also the price, but notice we've got a bit of so the start of this week so far, we've got a bit of a downturn there on the CCI, so nothing to panic about, but still bullish. On the daily, however, if I zoom in on this one, you can see there we've hit this resistance at 53,960, and it's moving back from there at the moment towards the moving average of the price chart. The CCI has already broken to the downside. Now we don't go short here. We want to wait for the price also to break to the downside as well. And we also look at the intraday time frame to get a better understanding as to what's happening. So again, predominantly at the moment neutral. I wouldn't go short or long at the moment, but at the moment on the 1 hour time frame here, you can see there after hitting that resistance on the 1 hour, it's actually broken down, and we did have a bearish divergence here, a double top on the CCI versus higher highs on the price, and that actually broke down, hit our 23-38% target range. And again, just to demonstrate, that's drawn from that. Let's go back to this area, I think it is. Sorry, back to here. Goes back to that. We'll take the low point before that divergence started, and that's at 23-38% level. Sometimes it can go a bit deeper, but in this case it just bounced off that initial 23-38% range, and it bounced off that. So not a huge one. So I don't trade these, by the way. I don't go short when I see these bearish divergence or bullish divergence. I'll use them as an exit point potentially. So if I was going long here on the daily or the hourly, and I started seeing this bearish divergence on the price and the CCI, then I potentially take my profits off the table. Now since then we've got no other divergence. That's moving in line with the price, so that's cool. We'll let it go. So again, don't go long or short until we see this either the price break below the moving averages, or we see the CCI break above those moving averages and the price then to also break through this resistance. In terms of the back testing, we've got here the stop loss approach and the average down approach. Let's move that up there. So what we've got here is we take the same approach on the hourly. So whenever the price breaks above the CCI, where the CCI breaks above the moving average and the price breaks above the moving average as well, that's indicated by these green backgrounds. We take a long position, or when the price and the CCI break below the moving averages, we take short positions. So here we're going predominantly, we trade in the direction of the daily, don't forget. So we trade on the hourly in the direction of the daily. So we take long positions only, we don't take short positions. So we've started the back test here when the price and the CCI broke above the moving averages. There on the, that was the 5th of March, indicated by this area back here. And you can see there, you would have taken some positions there. Now I've got here a cross, and that's indicated by when the price broke, or the CCI I should say, broke into that moving average range at that point. That's indicated by these crosses. So you've got to take a stop loss there based on the daily. And at that point there, you would have been about break even on both, at $64 on the stop loss approach and about $10 on the average down approach. So you take your stops there, and then you re-enter it the next day once the CCI and the price breaks above, and you started going long again. Now I've left this back test from the beginning to the end, but overall you can see there the average down has generated 16,104, and the average and the stop loss approach has generated 3,186. Now that's a baseline of 100,000 on both. That's allowing for a drawdown. So again, with the average down, you've got to be very careful, because you'll notice here, during this period when it did decline and it had a bit of a drawdown, if I drew let me just zoom in on this one, from that profitability to that point there, it declined by 5,126 on the average down, because you had a few contracts open there. On the stop loss approach, you were stopped out, but it reduced by $402. So you've got to be careful. You've got enough account balance to allow for any drawdown, but importantly, you've got to make sure that you don't trade against the trend of the higher trend. Also, another tip to look out for, you'll notice here, for example, if I zoom in a bit, the price was still making new highs. So if I was to draw from that, first look at the CCI, you notice the CCI is dropping to that peak there. That's lower high on the CCI versus higher highs on the price. So at that point, you would have taken notice, and potentially you would have got out of that was the first sign there, the first bearish divergence on that little peak, and it would have been wise to take your money off the table, and you would have got out near the top there. Now in this case, both the stop loss and the average down strategies would have closed out the position, but you would have not taken any more open trades on these ones here, because that high on the CCI was lower than that high on the price. So that's just a little warning. So even though the daily is showing you bullish momentum, the hourly is telling you to avoid taking any long trades. You don't take short trades, but you don't take the long trades either. Just wait until we see then the CCI and the price start to move in alignment. Next, looking at US crude, look at the long-term trends first. You can see here on the monthly, we're still below the moving averages of the price, and likewise it's broken below the CCI moving averages as well. So bearish momentum. On the weekly, that's also bearish, but notice it's actually broken into that moving average range of the CCI, and the price is still below the moving averages. That's a somewhat neutral positioning. Even though the price is bearish, the CCI is breaking to a neutral. So don't, if you're trading on the daily, don't take any long or short trades until we see this decisively break out one way or the other. On the daily, we've hit this support level down here at 65.04, and it's bounced off that. And you'll notice the CCI broke above the moving averages early on. The price is still below the moving averages. We don't take long trades until we see a more decisive break above. And ideally, you want to see these moving average bands narrow and then turn in the other direction. So probably one of these candles would have been ideal to start going long. That's given you a small window so far, long positioning if you're trading on the intraday time frame. So if we go to the intraday or the 1 hour time frame in the direction of the daily, you can see there you could have taken some long trades. Now notice here though, and I'll demonstrate the back test in a moment, but notice here you've got new highs on the price versus lower highs on the CCI. So that first little peak, the CCI and the price are moving in alignment, so that's not a divergence up until there. That one there is still questionable, but possibly that would have been a bearish divergence there. You can see there that was the first sign there, and that little peak. So the price is starting to fall against you, and then you had another peak there, a lower high. That's still a bearish divergence. And then the peaks started dropping from there until we got to this stage, and that was the last price peak we had. And then since then the CCI kept falling, and the price started to retrace as well. And in terms of a price retrace, oops, let me just do that again. A price Fibonacci retrace, the minimum retrace, I always say minimum because that's the minimum time area it's going to hit, is at 23-38% range, and it's currently in there at the moment. It hit it back here with those wicks and those hours, and it's risen from there, then it's finally broken to the downside again. Now notice the CCI is still dropping, and the price is potentially still dropping as well. Now I wouldn't be going short because the daily is still bullish on the price and the CCI. So that's what I'm saying. Just this is giving you a bit of a false signal at the moment. Avoid going long because of the hourly trend, and that's why you look at the smaller time frames, even if you're trading on the daily. So again, with the back test, what I've done, I've taken the back test for the stop loss and the average down approach back to where the price and the CCI broke above their respective moving averages, and that's indicated by these starting points here. Now, I've let the program run, or the backtest run, right to the very end so far. But again, always make sure you follow any bearish divergence. Now, in this case, that first little jump would have been okay, and you would have closed out the first lot there with a little gain there on the stop loss approach, and a little gain there as well on the average down approach. Now, since then, as we said, you would have entered, and then the price started to fall off, and so did the CCI, but the price started appreciating from there, and the CCI started to drop, and that's where you would have noticed the bearish divergence. So that first one would have been a bit of a potential risk, but it paid off, and you probably would have taken your money off the table and stopped taking trades somewhere along this period here, when the first major peak happened on the CCI versus the price. So somewhere around this area, you would have been wise to take your money off the table and been safe with your money management. Now, in this case, the average down approach was profitable, but the stop loss approach was negative. And again, notice here as well, if I zoom in on the drawdown on the profitability of the average down approach, that lost about $5,100 or 5% had you stayed in that trade. So again, just be careful. The stop loss, the average down approach looks profitable from a distance, but you've got to be very careful with your money management and allow for any drawdown, but always pay attention to these bearish divergence and take your money off the table if you ever see those, even though the daily might be going bullish. At the moment, definitely you'd be closing out your positions if you're profitable, with that daily CCI about to touch that moving average possibly in the next few hours. So here are the backtesting or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3, you got a total of 3 contracts now running, add another 4, you got a contract, 7 contracts running, add another 8, and then you got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're a smaller take profit return.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.